going on, everybody? 360 Digital Closing Bell here. I am your humble correspondent, Michael Tanner, joined live from an undisclosed location in Denver, Colorado, here on this beautiful May 8th, 2020. If you are listening to this on May 8th, we are actually recording this Thursday, about 2 o'clock, 2:30 in the afternoon, just to give you a little idea. So if anything crazy happens between now and tomorrow morning, we will make sure to update you. But we are, like I mentioned, live for episode number 14. I am joined, as always, by the executive producer of the show, the purveyor of the show, and the director and publisher of the world's greatest website, oilandgas360.com, Stuart Turley. He's joining us from Dallas. How you doing today, Stu?
I'm doing fantastic, Michael. We got a bunch on the news desk. Hey, real quick, you and I are working on a lot of things here at oilandgas360.com, and we got some nice social media coming out.
Oh, we do. We will get into, next week, we'll kind of give you guys an overview of everything that's going to be happening with social media. Before I dive into the show, I just want to spend a little time talking about our friends at Adamantine Energy, who is the best at ESG consulting company on the planet. I promise you, we had a great interview with their principal, Tisha Shule. And really what they're asking there is they're identifying social risk that's going for the energy sector. It's not just a commodity anymore or community opposition anymore. It is their opposition to specific development projects. It's everything from the success of divestiture from fossil fuels movement to investor engagement on your ESG programs to individual states setting ambiguous climate and decarbonization agenda. There's so much going on right now that Adamantine Energy can help you with. They're one of the leading consultancies helping the oil and gas sector prepare for all of the social risks. Like I mentioned, they're led by Tisha Shula, who's the former CEO of the Colorado Oil and Gas Association, and she helps guide energy companies just like yours to explore your exposure to social risk, your options for response, how your peer companies are responding to this, and the opportunities that social risk can actually create for your business. I would highly recommend going to www.energythinks.com to check them out more. You can also check out an interview that we did with Tisha Shula, the principal of Adamantine Energy. It's about a week and a half ago. It's probably our most watched video on the Energy 360 Network, and we really appreciate them being a sponsor of the show. Like I mentioned, we have a great show lined up for you. We're going to talk about really what we know about shut-ins and what that means. I think we've been talking for weeks now about shut-ins. What does this actually mean? What shut-ins have actually happened? And like I mentioned, what does that mean for us moving forward? As always, we will check the levels on crude oil, and we will get into all of the EIA numbers and everything of that sort. We will also check in with TomCat and how our portfolio is going. But before we do that, I do have a little bit of clerical work. Please, if you are not subscribed to this show on iTunes, Spotify, or Entercom's YouTube channel, please pause this show, subscribe, unsubscribe, resubscribe, do whatever makes the algorithm go nuts. We really appreciate all of your support. You can follow us on LinkedIn, Oil and Gas 360 and Entercom. Connect with me and Stu on LinkedIn, Michael Tanner and Stuart Turley. You can also check out all of the Energy 360 videos that we have dropped. We dropped a video with Premier Oilfield Group that dropped on Tuesday that I highly recommend watching, as it's going to be a great preset for our first segment that we're going to get into here in a little bit. We also dropped one with CAC Specialties. I know I personally learned a lot from that one. If you don't know what D&O insurance is, I'd highly recommend. I'm not even going to spoil it. I'm just going to force you to go to oilandgas360.com and watch it. We're also dropping one next week with Lucas Bio. And I don't know, is there anything else we can chat about that we're launching? What can we share with the fans?
Well, let's see. We've just cut a special on the Michael Moore movie this morning.
Yes, we did just cut that. That'll be a great one. We watched. If I highly recommend you guys doing this. It's called Planet of Humans on YouTube. It's a new Michael Moore documentary. And before I get to, I don't want to get too deep into it because I want you to watch the special. It's not pro fossil fuels, but man, is it anti-renewables. He goes hard after some of the renewable industries, and it's very fascinating. I highly recommend watching. We have a great interview that's dropping with me, Stu, and Dan, who's the director of consulting that at Entercom. But I think that about does it for everything clerical work. And really what I want to do is what I mentioned, is shift gears into the shutting in wells topic. And, over the past, I want to say 2-3 weeks, I think we've shifted from storage being a big issue to now, all right, what's happening with all the shut-in wells? I think we're seeing demand starting to rebalance itself. I was on a Rystad Energy webinar about a week ago that mentioned that we're starting to talk about flattening the curve in the coronavirus. We're starting to really flatten that demand curve. And I think as we start seeing it come back, the issue is now we're beginning to shut in wells. We've been chatting for about 2-3 weeks, and now we're actually starting to see it play out. And really, there's just been so much talk about it. I really wanted to sit down this morning and figure out, okay, well, what do we know actually about shut-ins? What are sort of the two schools of thought? And that's sort of what we come to when we talk about, all right, what's going on? There are really two schools of thought. And then what does all this mean moving forward for the oil and gas, specifically when it comes to the finance? And so when we focus on what we know, there's really three facts and really two facts that really we know about shutting in wells. One, we know that there are more wells producing less than 10 barrels a day than there are not. And that's a really crazy number to think about. I think everybody thinks about we're drilling fast shale wells in the Permian. Everybody's up fracking 3-mile long laterals in the Bakken. But really, when you look at the majority of the producing wells in this country are less than 10 barrels a day, which, some of those can identify themselves as a stripper well. The other thing that we know about all of these wells is that they're deep in the oil patch. Some of them are not terribly accessible. They're not all hooked up to the correct pipelines, and they do not have the correct ability to maybe shuttle this oil to where it needs to go in this time. And the third thing we know is really that people are split on what should happen. As we mentioned, since this coronavirus wave has hit, we've had company after company, specifically Pioneer Natural Resources, Parsley Energy, have come out and said, we need to shut in and actually prorate oil production. And so really, if we've got two schools of thought, obviously you've mentioned there are people split on what is happening with these shut-in wells, and there's two schools of thought. And one of them is that shutting in new shale wells will be pretty easy. Basically, it's very easy to shut in an ESP. Honestly, it's about half these wells that can be done remote anyway. It saves these higher production rates for what would be a better pricing environment. If you have a 1,000-barrel-a-day well, shutting it off now and turning it back on when oil might be, and you might be able to get $30, $40 for that, the pricing looks much better on that. And it allows you to save your low barrel wells to stay on. And that's key, because another thing we know is one thing we do know, and this is something I forgot to mention are 100% facts, but we do know that we're not sure if these wells will ever turn back on. Wells that are less than 10 barrels a day, we're not even sure if shutting them in will ever turn back on. So shutting in new shale wells, which is like we heard last week Nick Berry talk about shutting in a shale well is much like parking your new Ferrari in the garage. Probably going to turn back on with little to no maintenance as long as you only let it set there for a month. And like I mentioned, it's going to allow you to save those lower wells, the majority of the wells producing less than 10 barrels a day. It's going to allow you to keep those on, so you don't have to necessarily worry about, is my well going to turn back on or will it not? The other side of the coin, and this is really what I want to bring Stu in because he was actually on this interview, but the other school of thought is that it's not going to be easy and that there's a lot of things to consider before you just say, hey, let's turn off my largest well. And really, this was an interview we did with Premier Oilfield Group. It dropped on Tuesday. I know I teased it in the beginning, but really what they did was give a great overview from a reservoir side of what does the actual shut-in decision-making process look like and how does it actually play on the field. So before I kind of dive into my key thoughts from there, I want Stu to give an overview really of what's going on.
Hey, Michael, I'll tell you what, we always talk about having experts, and that's part of the 360 Energy Expert Network. And we had Blue and Frank from Premier Oilfield Service, and I mean, they were absolutely phenomenal, Michael. What we talked about is not only the parent-child relationship in a reservoir, it is also the fact that the fracking fluid, and when you shut in a well, it not only takes a look, but the fluid changes from all the fractures and the fluid coming down. It changes the entire mix. So when you come back online, not only is it just, oh, by the way, turning back on, there's now a fluid change, and you're not going to get the same mix that you were getting before. And that's where you were saying some of yours may not come back online. It's a totally different issue. So when you go into a field, you need to be able to say, I want to close that well, and you'll be able to really make the key decision. So the interview with Frank and Blue from Premier was absolutely phenomenal.
It really was. And really the one thing that I took away from that interview was the decline curve implications. And they mentioned this, that obviously shutting in your well, it's cutting off production. But what happens when you turn that well back online? What does that decline curve look like? Because obviously every well that's drilled, thousands of decline curves are generated for that specific well in trying to forecast how much oil is going to be. Now, what happens is when you settle on a decline curve, you project that cash flow based upon different levels of oil price, and that's fine. So most companies right now, they have a revenue scenario that they've mapped out for $20 oil, for $10 oil. Heck, they might even have it all the way down until their break-even point. Who knows how low they actually bring down these oil prices in their model? You can plug in anything. Maybe they've plugged in negative pricing for that negative $37 just to see what it would look like. But what happens is, so that these decline curves are what calculate revenue. Well, what happens if you turn a well back on that's now only producing 85% of what it originally was? Well, now you have to redraw your decline curve. Well, first you have to wait until more data comes, redraw your decline curve, and then just wait for the lower revenue values. Because how most of these companies go out and are able to service debt is to show our decline curves, and here's what our reserves are, here's how much oil's in the ground, and here's how much the commodity price is. So here's how much we expect to make in revenue. Can we have a loan off that? And that's a lot of how these debts works. That's why you need a professional engineer to stamp reserves, because you take a reserves to a bank and go get loans off that. You need to make sure someone's got to stamp that, and it's not me. So find yourself somebody who's PE licensed. They can go and stamp those reserves. But that was the key that I took away from the interview, and specifically why I fall, if we want to talk about the school of thought, I fall on the idea that this is a lot more complex than just picking your higher producing shale wells. Because even if you shut in those higher producing shale wells, what happens if you turn them on and they're only 80% of what they were? Well, those make up 60% of your cash flow revenue, and now all of a sudden you've lost 15% of revenue off your highest margin stuff. That doesn't do you any good. These stripper wells that are less than 10 barrels a day, they're making you any money. The only reason you still have them online is because to shut in a well, it cost you about $100,000, and that's partly why I'm going to add the link to a great article that actually talked about it, some research from Wood and McKinsey, talking about what it actually costs to like pull an ESP, pull rods, do some chemical treatment. Specifically, if you're going to shut in wells, I'd recommend calling 10X Technologies. They have a great nano clear substance that does a really good job. If you want to do help shutting your well, please give those guys a call. We did an interview with them on the 360 Network, another shameless plug for us, but they would be a great resource to reach out to if you're talking about doing chemical treatments to protect any equipment. But those even run you about $2,000 to $5,000 a job. So not necessarily a cheap endeavor, especially when oil is sitting, we're seeing negative pricing is sitting at $23 right now. So all that being said, that's what we know about shut-ins. We know there are two schools of thought ring on. Well, what does this all mean? Well, one of this means if you don't have shale wells, you kind of suck. It kind of sucks. There's not really a solution for you. If you don't have the ability to turn off a well that is, because when you lay out the scheme of what we know, shale wells do have a higher probability of turning back on, more so than the 10 barrel. The question is that percentage decrease, and that's really what we need to talk about. I don't care if one well turns on versus the other. The question is, what does it turn on to? What's the percentage drop from its original? And that's what you have to look for. We would call that marginal barrel of oil. The marginal barrel of oil is much better on the shale well than it is the non-shale well. So if you're vertical conventional, that kind of sucks, and you could be stuck. I mean, pulling rods is not expensive, and talk about restarting a cost. Yikes! I mean, that's at least $50,000 to send a workover crew and fix tubings or rods if you shut in, say, your conventional vertical. Another thing that this means is it also means that offshore is not going to be shut in. That's the one thing I want to bring up. We will not see offshore wells get shut in just due to the fact that there's so much oil being produced there that the pipes can't hold that much. You can only shut in these wells. I think offshore wells you can only shut in for it's a good 10 days before they fill up. They basically do it to enough where they get shut in during hurricanes. So as the hurricane passed, they turn the well back on. So outside of a 10-day shut-in period, very, very difficult to shut off offshore. So you're not going to be seeing them shut in. Really what you're going to be seeing is, domestic production is going to continue to fall. We're going to continue to see shut-in wells. As we see, as I mentioned, demand sort of kick and curl back. I think we're going to see a convergence between where these cuts have come to and where demand will end up. I mentioned a Rystad Energy webinar I was on. They mentioned that overall, because of this coronavirus sort of wake up that everyone is having and how the economy might have been permanently shifted, they see 5 million barrels a day being taken off the market as a new sort of demand level for oil and gas in America. That's what they see. So right now we're at 11.9 million barrels of production. We are up all the way just below 13 million barrels. So there's still a 4 million barrel gap. And when we talk about the shut-in numbers that have come out, it's not that much. I mean, we'll get to some of the numbers that Devon's dropping. We heard in the digital closing bell, one big thing today, Pioneer's only cutting off about 20,000 barrels per. So, I mean, the numbers aren't necessarily as big as maybe would have thought, but that's due to a lot of the reasons that we just mentioned. Shutting in wells is not a simple task. And I think it's the one big thing I'd have people take away. Shutting in wells is not easy. There's a lot of different considerations to come with it. And watch what wells get shut in and which wells don't. And it'll show you how these oil companies are thinking. That's the nice part about this situation is all you have to do is wait. If you're not sure what oil companies are going to, just wait and see, because they will do it and you will be able to see their strategy, and it'll be interesting to see how it all plays out. And then obviously turning on off these wells is a decision that's been talked about for 2 weeks. I can't wait to get into the next decision. All right, when do we turn them back on? And that will just be another great argument for everyone to have. I wonder if we'll have another anti-pro, an opposite proration meeting where they talk about how can we subsidize everyone to continue to drill more. But that's really, I just wanted to spend the first couple minutes of the show talking about shut-ins. What does it mean? What do we know? What do we don't know? And what are the speeds going forward? Before we move off this subject, Stu, anything I missed? Anything you need to get in about shut-ins?
No, I'll tell you what though, if you do listen to that interview, you've got to have experts. Good management, good numbers, but they rely on experts, and I learned a lot from that interview.
No, it is key. Obviously most oil companies are going to have, experts when it comes to shutting in wells. But if you don't, please go ahead and call Premier Oilfield Group. Shameless plug to those guys. They know their stuff. But I think that really covers shut-ins, and I think now it's just time to move into really the week that was in oil trading. As always, this segment is sponsored by our friends at Sandstone Capital Group. They provide all the research. They do insanely good research for this podcast. They provide it all, and it usually comes from their energy solution. They're starting to work on writing some articles, which will be very cool for oilandgas360.com. They're just experts when it comes to market research. Check them out, www.sandstonecg.com. You can give them a call, 949-561-1818, extension 101. And when we look at the week it was at oil trading, really what I see is a couple things. I think there's two stories, and then we'll get into the levels. Two stories is one was Shell selling their Appalachian assets. And this is really where we're going to start, when we talk about divestitures that are going to happen moving forward. This is one that's very, very interesting to play. As we know, oil M&As are going to be down. I think you're going to be seeing pennies on the dollar some of these pure oil companies be selling for when it comes to these mergers, just because of the fact that oil and gas is low. But we've talked about how valuable natural gas is moving forward, and we see this in Shell's sale of Appalachian shale assets. That is a tongue twister right there. Shell's Appalachian shale asset sale. That just is say that 5 times fast. But really, what they did was able to sell 300 producing Marcellus and Utica wells across 450,000 net acres. They were able to close for $541 million, and they announced this May 4th, which is taking into account everything is happening, which is an unbelievable number. It's an all-cash deal and up to $150 million in common stock, or about $38 a share. Goldman Sachs and JP Morgan Securities were advisors on this. And really, it just shows you how valuable natural gas is. It's about 250 million MCF per day of natural gas. And there's also about 142 of gathering pipelines that are included with that. But it's just a large number. And we've been seeing some M&A numbers being floated out, specifically from our friends at ExxonMobil. They've talked about acquiring companies for pennies on the dollar. The fact that Shell was able to get 541 million for some Marcellus and Utica wells just reissues the fact that we've been preaching this on the podcast. We've been preaching this in the Energy 360 Network. We have experts come talk about it. Natural gas will be the player moving forward, especially this summer. And I think you're going to see a lot of these shale gas assets sell for above market. I mean, that's a big number, Stu. 541 million for only 350 wells. I think it's a pretty good deal.
Oh yeah. And some of the key things is you've got the Marcellus that's going to continue producing at a pretty normal rate. They've had very good economics on their gas, but you do take a look at the Permian, all the wells being shut in, that's going to make a huge difference.
Yeah, it will. And the other thing that I just found interesting this week was Devon came out and announced some in their Q2 earnings. They announced that they're going to curtail about 10,000 barrels of oil production across the board, which is about 67% of their total crude output. Really what I found interesting, though, and why I want to bring them up, and is they mentioned in their earnings call this week that they're on track to close the sale of its legacy Barnett Shale to Thai conglomerate Bampu Kalin Ventures by the end of the year. The original agreement, which was inked in December of 2019, was $170 million upfront and potentially another $830 million on the back end, which is unbelievable. And now they've revised that agreement to come to about 770 million on the back end. So what an unbelievable sell of some Barnett shale that they're continuing to talk. And that's good to see. And so that's why I bring up both of these sales. One is because natural gas, as we mentioned, is going to be big moving forward, and other people are seeing it. And you're seeing the M&A market reflected, which if you really want to look at what is a confirmation of how the market is, if you're seeing what the market's seeing, look at the M&A deals, because no one's going to be spending 170 million in cash and 770 million on the back end if they don't have multiple minds and multiple people advising them on this deal. So if you were bullish on M&As for natural gas, you called this one right, and it's being reflected in the market. I'm going to give you a little pat on the back here, but I want to turn it over to Stu. What do you got for the news desk today?
Hey, we've had a pretty good international run here. I want to tell you about one of our biggest stories this week. Saturday, we had a big accident on the Orion, and it is a tender ship that's putting in wind farms, and the rig crane fell apart, Michael. And it was pretty amazing. We had the video on Oil and Gas 360, and then the second update to it showed the additional damage. Unbelievable. Glad nobody was hurt, man.
Yeah.
Unbelievable video. And so the other one is BP has revised its deal in selling in the Alaska portion that it was selling off. Amended some of the financial terms in the $5.6 billion sale of its Alaska business. You nailed it just a minute ago, and that is deals are changing throughout this whole time period. So.
No, deals are changing it. I remember seeing that number close in December, thinking, wow, that's a big number for Alaska. Now, even in this post-coronavirus, everyone slashing CapEx, M&A's coming to a halt, that number even sounds bigger. If they can get anything close to that, it would be awesome, because I don't see Alaska being a very profitable oil and gas field moving forward, especially when ESG will continue to be on top of the minds. I know Alaska has a lot of dealing with that. So we will keep you updated on everything that continues to happen with this M&A, and we will obviously bring in experts to continue to chat about that. When we get into the levels for the week, this was my first, I mentioned a week ago on the podcast that I've been doing very well with my levels. The moment I said something, it absolutely tanked on us, and I just had a very bad week. In a good way. I was a little more bearish on oil this week than I think most people were, and obviously the market thought so. We are now, on this week, we're doing about 5%. We're currently trading 23.54, but it was all the way up to 26.69 for the high for the week. So a great week if you were a bull on oil. And really how I see the levels on the bull side, 23.65, as I mentioned, is what we're trading at now. I think that's your pivot point to the upside. I see 24.37, 26.69, 29.43. Those are your big volume chunks. And now we're beginning to see that volume fill in on the upside, because I mentioned if you're a bear, you just have huge blocks of volume to fall back on. Partly why my bias tends that way. Between 20 and 17.93, or about 20 and 18 dollars, there's a huge block of volume. I think that's going to act as a huge point of resistance. We can have our levels to the downside, but unless that negative pricing happens again, which we will remember watching that as we move into, and this June contract gets closer to expiry, we will be watching to see if that contango environment, or that contango negative pricing happens again. Excuse me. But if it does, we will catch you. But I don't know if it's going to happen anymore. I mean, really, I would have not expected oil to be $23 at this point. As we move closer, we'll obviously keep you updated. But really, I think we're going to see oil continue to hang out in this $20 to $30 range, unless obviously we see some of this storage stuff, which, it's funny. No one's talking about storage anymore. 2 weeks ago, everyone was talking about storage. Now everyone's talking about shut-ins, when really it's storage hasn't really changed. And, maybe we should continue to keeping people updated with that. But, and really on a storage front, DOE came out this week, 2.1 million barrel build and Cushing, bringing up to 65.4 million barrels. So really good number to see when we're talking about the increase. We were seeing a lot bigger builds in the previous week in terms of overall U.S. builds. DOE reports only 4.6 million increase versus a 8 million barrel expected, which was very good. And here was the key. Total domestic production was down 200,000 barrels to 11.9 million barrels. We are finally below that 12 million barrel hump, which is great to see. Down 200,000 is another good number. Hopefully we continue to see that increase week over week. I know I mentioned a while ago, but I was looking to see 200,000 to 300,000 be taken off the market a couple weeks ago. The fact that it took until May 7th, or excuse me, May 4th or 5th to really see that is a little depressing, unfortunately. But the fact that we're here, it's good to see. And as we continue to see these domestic production getting cut, along with domestic demand rising, I really think that's going to help oil. And just so everybody knows, I'm expecting a reverse quarantine at some point. And I think people are going to go hog wild when everything gets opened back up. I know I'm itching to get out of quarantine and just go do something where there's other people involved. So maybe I'm the only one that feels that way. And I know I've gotten opinions on the other side, but if demand continues to come back and production gets into full, we might see we might be disagreeing with Scott Sheffield came out today, said we may never see $60 a barrel oil, if depending on how quickly we cut and how quickly we can turn it back on, you never know what we could see. So it'd be very interesting to see. And the EIA numbers leave a really interesting story. But I think with that, we're going to go ahead and just shift into our final segment, which is our picks for the week in our 360 fund. Before we do that, the lawyers make us say this so we don't get sued. Remember, this segment is always for entertainment purposes only. Everybody on the show, i.e. me, Michael Tanner, and Stuart Turley, we invest money for our own account and do not manage any outside money. We do not give investment advice. We do not offer securities or have any involvement in the regulated side of the industry. Remember, investing is risky and you can lose your entire principal. With that being said, Stu, how do your picks do this week?
Doing fantastic, Michael. Actually, I was up from last week. Let me run through the numbers here real quick. LNG Cheniere, I'm up 1.67%. In phase, which is the chip maker for the solar, actually up 3.44%. NBL Noble, actually up just basically 1%. And down here at Pioneer, I'm up 6.3%. Fang actually doing
Pioneer.
pretty.
No, I was on Pioneer's earning call this morning. They beat their EPS, which was good to see, especially, and revenue came in exactly as what they thought. And now, I mean, Scott Sheffield knew what he was doing. He was pumping out some of this stuff. I mean, they knew what these numbers were going to be. But in terms of what the market saw, market was not expecting it. So Pioneer, great call. They had a great day today.
Oh, you bet. And down to Rattler. I'm up 10% in Rattler, and Geopark's kind of hanging just right on in there. So actually, I'm kind of surprised at my picks.
Portfolio's doing well. And you said TomCat's been bottom feeding this whole week.
Oh yeah, TomCat's bottom feeding. Yeah, he's kind of watching things a little better than I am on HLX. 2 he's up a 1.4%. PVAC, which is Penn, Virginia. I would have not picked that one. He's up 11.78%. And yeah, Oil States International, he's just kind of hanging tough in there, but he is green. And then you got Newark Resources. He's up 8.4%. So TomCat's doing better than I am.
No, he's doing very well. You're both doing better than me because I didn't take out any positions this week other than taking out one more futures contract on natural gas. So that brings up my entry price to $1.90 even, but it's really good to see. I'm bullish on that moving forward. As always, I have my 65 shares of Bonanza Creek. We entered at $14.89, currently trading at $17.12. So, it's up about $3. I like that. It's only, but now to give you an example, 65 shares up about $3. I mean, that's only like $360 here. So there's more money to be made. We're looking to add the portfolio. As always, I'm looking for a longer term play to get in on. I'm not quite seeing anything I want to get on quite yet. But as always, this weekend, I'll do some research and let you guys know. TomCat, good to see him back bottom feeding. He was very successful with that a couple weeks ago. He's been a little silent, and he's back on the bottom feeding train. I like it.
Yeah, he's going through that, and you got to have a strong stomach for some of the picks he's picking, but he's on the money.
And a lot of screens, which I love. So, that kind of wraps up what our 360 fund looks like for the day. And we're going to let you guys get out of here with a nice, quick, short episode. Let you guys get back to work. Thank you for checking out the 360 Digital Closing Bell podcast. We'll let you guys, like I mentioned, get back to work, and we'll see you this afternoon for the Digital